Hey friends, welcome to the Crypto Pump channel, the place where crypto becomes clear and accessible to everyone. We're here to help you navigate the complexities of the market, learn how to trade with confidence, and avoid unnecessary risks. Today's episode is your guide through one of the most exciting topics in trading. Let's dive in. In this video, we'll take a deep look at futures trading on the Bybit platform, a powerful tool that lets you profit from both rising and falling prices with leverage up to 100x. You'll learn how to properly open long and short positions, use different types of orders, including stop losses and trailing stops, and manage your risk like a pro. We'll also break down how leverage can boost your profits, but why it also demands extra caution due to the risk of liquidation. This is a full-on guide packed with examples and practical tips for anyone who wants to trade consciously and confidently. Want to go beyond just understanding futures and actually start applying strategies in real trading? Then make sure to subscribe to our Telegram channel. You'll find up-to-date guides, market breakdowns, tips from real traders, and a vibrant community where you can ask questions, discuss trades, and get support. We regularly share valuable content to help you level up your skills and make smarter trading decisions. Links in the description. Join us, it's going to be worth it. What are futures and how do they work? Futures on Bybit aren't about buying the cryptocurrency itself. They're contracts with the exchange where you make a prediction about price movement. Think of it like this. You're entering an agreement that says, I'll buy Bitcoin at today's price in the future. If the price goes up, you profit from the difference. If it drops, you take a loss. You don't actually own the coin. You're trading a contract that lets you earn based on your forecast. This gives you flexibility and the ability to profit whether the market is rising or falling. Futures originally came from agriculture. Farmers use them to lock in prices for future harvests. For example, a wheat farmer might agree to sell his crop at a fixed price by fall. Even if the market price changes, the contract terms stay the same. The farmer knows what he'll earn, and the buyer knows what he'll pay. In crypto, this idea evolved. You don't receive the asset physically, you just speculate on its price direction. Bybit futures let you react quickly to market moves. You don't need to buy crypto and wait for it to rise. Instead, you open a contract with the exchange. If your prediction is right, you earn. If not, you lose only what you invested. Say you believe Bitcoin will go up, you open a long position, and if the price climbs, you lock in profit. Or the opposite, you expect a drop, borrow Bitcoin from the exchange, sell it, then buy it back cheaper, and keep the difference. This isn't classic trading where you buy coins and just wait for the price to go up. Here, you don't actually own the cryptocurrency. You're making a bet on its price movement. You can earn both when the price rises and when it falls. That's why futures are often called trading thin air. You don't hold the asset itself, just a contract and settlements with the exchange. So, what's your experience with futures? Drop a comment below. We'd love to know who's already in profit and who's just getting started. Let's see if it's really true that 90% of traders lose their deposits, or if the reality is more nuanced. Long and short. How to earn on price changes. Long means you're betting on the price going up. You open a position expecting Bitcoin to rise. If the price does go up, you close the trade and earn the difference between your entry and exit. It's similar to the classic buy low, sell high strategy. Except here, you don't actually hold the asset in a wallet. Everything happens through a contract, without physically owning the cryptocurrency. Short is the opposite. You're expecting the price to fall. You borrow Bitcoin from the exchange, sell it at the current price, and then buy it back cheaper once the price drops. The difference between the sell and buyback price is your profit. For example, you borrow Bitcoin, sell it, wait for the price to drop, buy it back at a lower price, return it to the exchange, and keep the profit. This strategy lets you earn even in a falling market, which isn't possible with traditional spot trading. Futures stand out from regular crypto buying because they allow you to profit not only when the market goes up, but also when it goes down. In spot trading, you simply buy a coin and wait for it to rise in value to sell at a profit. But with futures, it's different. If you believe the market will drop, you can open a short and earn on the decline. That makes this tool especially flexible. You're not tied to market direction and can stay active even during downturns. That said, it's important to remember, shorting is riskier than going long. Prices can rise indefinitely, but there's a limit to how far they can fall. If the market suddenly reverses, your losses can exceed expectations. That's why short positions require extra caution and a solid understanding of market conditions. Let's break down the next stage, how to start trading futures on Bybit. This setup is perfect for opening short-term positions and reacting quickly to market movements. To get started, go to the derivatives section on the Bybit website or app. That's where you'll find all the tools for futures trading and contract management. Next, choose the contract type, USDT Perpetual. It's one of the most popular options. It's tied to the stablecoin USDT and doesn't have an expiration date. Then, select your trading pair, for example, BTC USDT, which means you're trading Bitcoin against USDT. Simple as that. Pick the pair and the trading terminal opens up, ready for action. Before opening a position, make sure to transfer funds to your futures account. Bybit has a main wallet. From there, you send the desired amount, say in USDT, to your futures wallet. It's easy. Go to Assets, choose Transfer, enter the amount, and confirm. Once the funds are in, you're ready to trade. Bybit is a great platform for futures trading. The interface is intuitive and everything is clearly laid out. You can quickly open a long or short, set stop loss and take profit levels. I'll cover that in more detail a bit later. The exchange is well suited for managing risk and is beginner friendly. And if you register using my referral link, you can get bonuses of up to $30,000. The link's in the description, don't miss out. And so, the next stage is leverage. How it increases both profit and risk. Leverage on Bybit allows you to trade with more capital than you actually have. For example, if you have $1,000 and choose 10x leverage, the exchange adds $9,000, letting you open a $10,000 position. You're entering a futures contract, let's say on Bitcoin, and now every price movement affects the full $10,000, not just your initial $1,000. If you go long with leverage, you're betting on the price going up. Let's say Bitcoin is at a certain price, and you enter a trade with 10x leverage. If the price rises by 10%, you earn $1,000, even though you only invested $1,000, because the profit is calculated from the full contract size. Without leverage, your profit would have been just $100. But leverage comes with risk. If the market moves against you, losses also multiply. In the same example, if the price drops by 12%, your position will be liquidated. The exchange will close it automatically, and you'll lose your entire investment. That's why it's crucial to be extra cautious when using leverage. Risk management is key when trading with leverage. Without it, you can lose your funds very quickly. For beginners, it's better to start with lower leverage, like 3x or 5x, to keep potential losses under control. Bybit also offers a liquidation calculator, which helps you see in advance at what price your position would be closed. It's a useful tool for managing risk effectively. Now let's break down what margin is, how it affects your trading. Margin in Bybit futures trading is the amount you put up as collateral to open a position. When trading with leverage, the exchange provides additional funds, but a portion of the capital, your margin, must be in your account. There are two types of margin, isolated and cross. With isolated margin, your risk is limited to the amount you've allocated to a specific position. For example, if your total balance is $10,000 and you use $1,000 as margin, then in case of liquidation, you only lose that $1,000. The rest of your funds remain untouched. Cross margin, on the other hand, uses your entire account balance as collateral. If the market moves against you, the exchange can draw from your full deposit. In the worst-case scenario, you could lose everything. For beginners, it's safer to start with isolated margin. It helps limit losses and protects the rest of your capital. Choosing the right margin mode is a key step in managing risk effectively. The next key element is risk management. Without it, consistent trading is impossible. In Bybit futures, it's all about controlling your positions so you don't blow your entire account, especially when using leverage or trading with large amounts. It's not just a helpful skill, it's the foundation. Without it, a couple of bad trades can wipe you out completely. When trading futures, always remember, you're risking real money. Without a clear understanding of risk, a single mistake can lead to full liquidation, especially with 10x leverage or cross margin, where losses can escalate quickly. Risk management helps you define in advance how much you're willing to lose and protects your capital, so you can keep trading even after setbacks. To manage risk effectively, you need to know what tools are available on Bybit. You can use stop-loss orders. We'll talk more about those later in this video, to limit losses, or choose an isolated margin to risk only a portion of your funds. The key is to understand the basics and not rush into trades blindly. Want to learn how to manage risk and protect your capital? Join our Telegram channel. You'll find practical tips and proven strategies for confident trading. Links in the description. Come check it out. Next, let's talk about the market and limit orders, what they are and how to use them. On Bybit, there are two main ways to open a trade: market orders and limit orders. These tools let you enter a position in the way that suits you best, fast or precise. Each has its own purpose, and it's important to understand when and how to use them for smart, effective trading. Let's start with the market order. This is the fastest way to open a position. At the current market price, you simply enter the amount, say 0.1 BTC, and hit the button. The trade is executed instantly, with no waiting. There's a small fee, roughly around $3, but it's worth it when the market is moving fast, and you don't want to miss the moment to go long or short. The key benefit: you enter the trade immediately, at the price available right now. The second option is the limit order. Here, you set the price at which you want to enter the market and wait for the price to reach that level. For example, if you want to buy Bitcoin below the current price, you place a limit order, and it will only execute once the market hits your target. This gives you more control, but there's a chance the trade won't open if the price never reaches your level. It's a good choice if you're not in a rush and want a more precise entry. You can also customize your orders. Set the amount in BTC, like 0.1, or in dollars, say 1,000. You can even define the margin, and the system will automatically calculate how much Bitcoin you'll get. Finally, let's talk about stop loss and take profit and why they are important. Stop loss and take profit are essential tools for managing positions in futures trading. They allow you to set clear boundaries in advance, how much you're willing to lose and how much you aim to gain. This is a key part of risk management, helping you avoid unexpected losses and lock in profits at the right time. A stop loss is a protective order that automatically closes your position if the price moves against you. You set a level in advance where you're ready to exit the trade. For example, if you open a long position and the market starts to drop, once the price hits your stop level, the position closes and you only lose what you were prepared to risk. This is especially useful when you can't monitor the chart constantly. A take profit works the opposite way. It locks in your profit when the price reaches your target. You set the level where you want to exit with gains, and once the market hits that point, the trade closes automatically. This helps you secure profits before the market has a chance to reverse. You can set these orders right when opening a trade, or add them later once the market starts moving. For example, you enter a long position, everything's going according to plan. You add a stop loss just below your entry and a take profit above. This way, you stay in control. Losses are limited, and profits are secured on time. It makes trading more calm and predictable, especially helpful for beginners. What is a trailing stop, and why is it needed? A trailing stop is a special type of order that helps you lock in profits as the price moves in your favor. Unlike a regular stop loss, it doesn't stay fixed. The trailing stop follows the price, automatically adjusting as it rises. Here's how it works. Let's say you open a long position and set a trailing stop with a 3% offset. If the price goes up, the stop moves up with it, always staying 3% below the highest price reached. When the market reverses and drops by that 3%, the order is triggered and your position closes, locking in your profit. This way, you protect your gains even if the price suddenly turns against you. Imagine you're in a long trade and the price starts climbing. The trailing stop moves up with each new high. If the market then pulls back by the set percentage, the stop is hit and the position closes. You don't lose all your profit, you secure most of it. This is especially useful in futures trading, where volatility is high and reversals can happen quickly. A trailing stop gives your trade room to grow while still managing risk. It adapts automatically to market movement, so you don't have to manually adjust your stop loss every time the price changes. It's a smart tool to help you protect profits once your trade is in the green. What are conditional orders? How to trade based on market signals. This is a way to automatically open a trade when the price reaches a level you've set in advance. These types of orders only trigger when specific conditions are met, allowing you to enter the market without constantly watching the charts. It's a great tool for traders who want to catch the right moment without being glued to the screen all day. The mechanics are simple. You set a trigger price, the level at which the order will activate. For example, if you're expecting a breakout to the upside, you place a conditional long order. Once the price hits your trigger, the trade opens automatically. Or if you're anticipating a drop, you can set a short order with a trigger below the current price. When the market reaches that level, the order is executed and you enter the trade. These orders make trading more precise and flexible. You can plan your entry in advance and avoid missing opportunities if the market moves quickly, especially important in futures, where every second counts. Conditional orders give you automation and control in one powerful tool. For those of you who made it almost to the end, here's a bonus. Let's break down a couple of extra tools that can help save your position. The first one is adding margin. If your trade is close to liquidation, you can deposit additional funds to push that critical level further away. Let's say you invested $500, but the market moved against you. By adding another $500, your total margin becomes $1,000. This shifts the liquidation price farther, giving your position more room to survive and possibly recover if the market turns in your favor. The second tool is setting multiple take profits. Instead of aiming for just one profit target, you can set several. For example, you open a long position and want to take profits in stages. The first take profit closes 1/3 of the position, the second closes another third, and the rest stays open in case the price continues to rise. This strategy lets you secure some gains early, while still leaving room for bigger potential profits. You're essentially splitting the trade into parts and closing them step by step. Smart and strategic. Bybit also offers automation tools to make trading easier. One of them is the Futures Grid bot. It automatically opens and closes trades based on a preset price grid, earning from market fluctuations. It's a great option if you want to profit from price movements without constantly monitoring the charts. Another option is copy trading. You choose an experienced trader, connect to their strategy, and automatically mirror their trades. It's a great way to learn by doing and earn alongside professionals, even if you're still gaining experience. Friends, now you know how to approach futures trading the smart way. Want more helpful tips, market analysis, strategies, and real-world examples? Then be sure to check out our Telegram. The link is in the description. If you found this video helpful, give it a like, share it with your friends, and drop a comment below. Let us know what you found most interesting or what you'd like us to cover next. See you in the next video. We've got even more hands-on tips and trading insights coming your way.